Here's something that surprises almost everyone. If you walk into your bank and deposit $10,000 in cash, your bank is legally required to report you to the federal government. Not because you're suspicious, not because you're in trouble. It's just the law. And here's the part that really gets people. You don't even need to hit that $10,000 mark. Depositing smaller amounts in a way that looks like you're trying to dodge the rule can get you flagged too. And in some cases, it can lead to your funds being frozen or even seized. So if you've ever sold a car for cash, received an inheritance, run a small cash-heavy business, or just kept your savings under the mattress, you need to understand these rules before you make your next deposit. Welcome back to Money Regulation Hub, the channel where we break down the financial rules that affect your everyday life. No legal jargon, no confusion, just straight answers. Today we're tackling a topic that touches millions of Americans every year, but that almost nobody actually understands. Federal reporting rules for large cash deposits. By the end of this video, you'll know exactly what the $10,000 reporting rule actually is, and where it comes from, what a currency transaction report is, and what happens after your bank files one, why structuring your deposits to avoid reporting can land you in serious legal trouble even if your money is completely legal, how these rules apply to businesses and not just individuals, and what you should actually do if you're about to make a large cash deposit. This isn't about avoiding the system, it's about understanding it, so a routine deposit never turns into an unnecessary headache. Let's get into it. Let's start with the basics. The reporting requirement for cash transactions comes from a law passed back in 1970 called the Bank Secrecy Act, often shortened to the BSA. Despite the name, the Bank Secrecy Act isn't about keeping your information secret. It's actually the opposite. It requires banks and other financial institutions to keep records and file reports that help the government track large movements of cash. The goal was, and still is, to make it harder for criminals to hide illegal money by moving it through the banking system, a process commonly known as money laundering. Think of it this way. Cash is anonymous. A wire transfer or a check leaves a paper trail connecting two named parties. Cash doesn't. So lawmakers decided that once cash transactions cross a certain size, banks need to start keeping a record of who's involved. That threshold is $10,000. Whenever you deposit, withdraw, or exchange more than $10,000 in cash in a single business day, your bank is required to file what's called a currency transaction report, or CTR, with the federal government, specifically with an agency called FinCEN, the Financial Crimes Enforcement Network, which operates under the U.S. Treasury Department. Here's what actually happens behind the scenes. You walk up to the counter, deposit $12,000 in cash. The teller processes your transaction like normal, you get your receipt, your money is in your account. But behind the scenes, the bank's compliance team fills out a CTR that includes your name, address, social security number, occupation, and details about the transaction itself. Now here's an important point, and this is where a lot of people get nervous for no reason. Filing a CTR is not an accusation of wrongdoing. It's completely routine. Banks file millions of these every single year. If you deposit an inheritance check that you cashed, sell a used car for cash, or you're a landlord collecting rent in cash, and it crosses $10,000, a CTR gets filed automatically. It doesn't mean you're under investigation. It's simply the law doing what it's designed to do, creating a paper trail for large cash movements. Let's use a real-world example. Imagine Maria, a small restaurant owner, deposits $11,500 in cash on a Friday after a busy week. Her bank teller processes the deposit normally, but the bank quietly files a CTR that day. Maria never even knows it happened. Nothing changes for her. No calls, no scrutiny, no delays. It just becomes part of a national database used to spot unusual patterns over time. Now here's where things get serious, and this is genuinely the most important part of this video. Because people know about the $10, $1,000 threshold, some try to get clever. They'll deposit $9,500 today, $9,000 tomorrow, and $8,500 the day after, thinking they're avoiding paperwork. This practice has a name: structuring. Structuring is the act of deliberately breaking up cash transactions specifically to stay under the $10,000 reporting threshold. And here's the critical part. Structuring is a federal crime, even if the money is completely legal. I want to repeat that because it surprises so many people. It doesn't matter if the cash came from a legitimate business, a legal settlement, or your own savings. If you structure your deposits with the intent to avoid a CTR being filed, you can face criminal charges, and the government can seize the funds involved through a process called civil asset forfeiture, sometimes without even filing criminal charges against you. There have been real documented cases of small business owners, restaurant owners, convenience store operators who made repeated cash deposits just under $10,000 because a bank employee told them it would be simpler, not realizing that pattern alone can trigger a structuring investigation. In several widely reported cases from the past decade, business owners had tens of thousands of dollars seized by federal authorities, and some had to fight for months or years in court just to get their own legally earned money back. So here's the golden rule. Never deposit or withdraw cash in a way specifically designed to avoid the $10 zero threshold. If you have $15,000 in cash, deposit $15,000 in cash. Don't split it up to make it easier. The reporting itself is not the problem. Trying to dodge it is. This next part is especially important if you run a business that deals in cash. Think car dealerships, jewelry stores, contractors, or pawn shops. The IRS has a separate but related requirement called Form 8300. Any trade or business that receives more than $10,000 in cash in a single transaction or in related transactions must report it directly to the IRS using this form and provide a written statement to the customer confirming it was filed. For example, if you buy a used car from a private dealership and pay $12,000 in cash, that dealership is required to file Form 8300 with details about you and the transaction. This applies to cash, meaning physical currency, not personal checks, cashier's checks over $10,000, or wire transfers, which have their own separate reporting frameworks. This is why, if you're planning a large cash purchase, it's smart to ask ahead of time whether the business is required to report it. It's not something to fear, it's simply part of doing a large transaction in cash within the US financial system. Let's bring this back down to earth, because most of you watching aren't running cash-heavy businesses. You're everyday people who might occasionally deal with a large amount of cash. Common situations where this comes up include selling a car privately and depositing the proceeds, receiving a cash gift or inheritance, cashing out savings you've kept at home, running a small side hustle that deals in cash like a food stall or a barber shop, or winning cash at a casino, which has its own reporting rules through Form W2G and similar thresholds. In every one of these cases, the smart move is the same. Just deposit the money normally in one transaction and let the bank handle the paperwork. You may be asked a few simple questions like where the cash came from, not because you're suspected of anything, but because banks are required to document the source of large cash deposits as part of their own compliance obligations. Being upfront and straightforward is always your best move. Trying to be clever about it is what actually creates risk. A lot of people ask, isn't this a privacy violation? It's a fair question, and courts have actually weighed in on this over the decades. The general legal position is that reporting requirements on financial institutions are considered a reasonable tool for law enforcement, and they've been upheld under U.S. law, though the topic still generates real debate among privacy advocates and civil liberties organizations about how much financial surveillance is appropriate. That's a legitimate ongoing conversation, but as it stands today, these reporting requirements are current law, and understanding them protects you far more than ignoring them ever will. Let's bring it all together. Here's what you need to remember. The $10,000 rule is real. Any cash transaction over that amount typically triggers a currency transaction report from your bank, and this is routine, automatic, and not an accusation. Filing a CTR is normal, and millions are filed every year without meaning anyone is under investigation. Structuring is a serious federal crime. Breaking up deposits specifically to avoid the $10 zeros and threshold can lead to criminal charges and asset forfeiture, even when the money is completely legitimate. Businesses have their own rules through IRS Form 8300 for cash payments over $10,000 received in trade or business transactions. And the safest approach is always the simplest one. Deposit your cash honestly, in full, in one transaction, and let the system do what it's designed to do. Understanding these rules doesn't just keep you compliant, it protects your money and your peace of mind. And that wraps up today's breakdown of federal reporting rules for large cash deposits. If this video helped clear up something you've always wondered about, do me a favor and hit that like button. It genuinely helps this channel reach more people who need this information. If you're new here, subscribe and turn on notifications because we publish new videos on banking rules, financial regulations, and money management every single week. I'd love to hear from you. Drop a comment below and let me know. Have you ever had a large cash transaction flagged? Or did you learn something today that surprised you? I read every comment and often turn your questions into future videos. And if you know someone, a small business owner, a friend who just sold a car, anyone dealing with cash, share this video with them. It could genuinely save them a headache. Coming up next in this series, we're diving into a topic that trips up even experienced investors: how the IRS really tracks your bank account. You won't want to miss it, so make sure you're subscribed. Thanks for watching Money Regulation Hub. I'll see you in the next one. A stack of $100 bills partially covered by a bold red flaghead stamp graphic with a bank building silhouette in the background works well as a thumbnail. Pair it with a shocked or concerned reaction shot and bold text reading "Deposit $10,000." The bank must report you. using deep green paired with red and black for contrast for the video description. Did you know your bank is legally required to report you to the federal government if you deposit $10,000 or more in cash? This video breaks down federal cash deposit reporting rules, including the Bank Secrecy Act, currency transaction reports, IRS Form 8300, and the serious legal risks of structuring your deposits to avoid reporting, even when your money is completely legal. Whether you're a small business owner, sold a car for cash, received an inheritance, or just want to understand how the banking system really works, this video gives you clear, practical answers with no legal jargon and no confusion. Subscribe for weekly videos on banking rules, financial regulations, and smart money management. Keywords: cash deposit reporting rules, $10,000 cash deposit law, currency transaction report, CTR Bank Secrecy Act explained, IRS Form 8300, structuring cash deposits, cash deposit federal law, FinCEN reporting, large cash deposit rules, banking regulations explained, and money laundering laws, cash transaction reporting, IRS.